Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host here at Algobot, and today we're examining an expert advisor called Turtle Soup Reversal. This is a pure price action strategy inspired by the well-known ICT concept of a liquidity sweep. There are no indicators at all, just market structure and the behavior of the candles themselves. Over the next few minutes, you'll learn how it spots a failed breakout, how it defines its entries, stops, and targets, and how the underlying code makes those decisions. Remember, everything here is educational information only and not financial advice. Let's dive in. So what exactly does the Turtle Soup Reversal Expert Advisor do? At its heart, this is a reversal strategy that fades failed breakouts. It is built entirely on price action and market structure, which means it reads the shape of recent candles rather than relying on any traditional indicator like a moving average or an oscillator. The core idea comes from the ICT concept, often called a liquidity sweep. Traders tend to place their stop orders just beyond an obvious swing high or swing low. Those clustered stops form a pool of resting liquidity. Sometimes price will push through that level, take out those stops, and then quickly snap back into the prior range. When that happens, the breakout has failed, and the candle that did the sweeping becomes a potential reversal point. The Turtle Soup reversal strategy looks for exactly that pattern and then positions in the opposite direction of the failed move. This approach is flexible enough to run on most markets and timeframes that the MetaTrader 5 platform supports, from major currency pairs to indices and metals, although the behavior will differ from one instrument to another. Because it acts only on fully closed candles and takes a single position at a time, it tends to appeal to traders who prefer a structured, rules-based approach rather than constant screen watching. It is particularly interesting to those who want to study how institutional-style liquidity concepts can be expressed in clean, testable code. As always, the goal of this video is education. We are not promising any particular outcome, and trading always involves the risk of loss. Instead, we are unpacking how the logic is constructed so you can understand it, test it for yourself, and decide whether the concept fits the way you think about the markets. Let's walk through the logic step by step. First, the strategy only evaluates the market once a candle has fully closed. It watches the forming bar, and when a new bar begins, it knows the previous candle is now complete. It also allows just one open position at a time, letting the stop loss and take profit manage the exit before it considers another setup. Next, it needs enough history on the chart, so it checks that there are sufficient bars before doing anything else. The just closed candle becomes the candidate, what the strategy calls the sweep candle or order block. The strategy measures that candle's full range, from high to low, because several of its decisions are scaled to that range. Then it searches backwards for the most recent confirmed swing high. A swing high is a fractal, a bar whose high stands above the highs of a set number of bars on each side, controlled by the SwingLookback setting. It only scans within the LiquidityLookback window, so it focuses on recent structure. Once it locates that swing high, two conditions must both be true. First, the level must still be resting, meaning no candle between the swing and the sweep candle had already traded above it. Second, the sweep must be genuine. The candle's high has to pierce above the level by at least a minimum fraction of its range, set by MinRaidFraction, so a barely touching wick doesn't count. Crucially, the candle must then close back below the level and close below its open, showing a clear rejection. When all of that lines up, the strategy signals a short. The mirror image applies on the downside. It finds a confirmed swing low, checks that the level was still resting, and looks for a candle that dips below it by the minimum amount, then closes back above the level and above its open. That signals a long. For a short, the entry is taken at the bid, and the stop loss is placed just above the swept high, padded by the buffer fraction of the candle range. The distance from entry to stop becomes the risk, and the take profit is set at that risk multiplied by the TpRewardRisk multiple. A long is the exact reverse, with the stop just below the swept low. This keeps every trade defined by structure, with a consistent reward-to-risk shape. Let's read through the code as it would appear in MetaEditor. At the top are the input parameters, the dials you can adjust on the EA's Settings tab. SwingLookback, set to 2, controls how many bars must sit on each side of a candle for it to count as a confirmed swing. A larger value demands a more pronounced, isolated swing. Liquidity lookback, set to 20, is how far back the strategy scans for that swing, so it stays focused on recent structure. Buffer fraction, at 0.15, decides how much breathing room the stop gets beyond the swept extreme, expressed as a fraction of the sweep candle's range. TpRewardRisk, at 2, sets the take-profit distance as a multiple of the risk, so a value of 2 aims for twice the distance of the stop. MinRaidFraction, at 0.10, defines how far price must pierce past the level before it counts as a genuine sweep rather than a small wick. And lots sets the trade volume. Now the signal block. The function find swing high returns the bar position of the most recent confirmed swing high, and if one exists, the code reads its price into the variable called level. The resting check confirms that no candle in between had already traded above that level, so the liquidity is still untouched. The rated check is the heart of the setup. The just closed candle's high must exceed the level by at least the minimum fraction of its range. Its close must fall back below the level, and its close must be below its open, showing rejection. When both resting and rated are true, the strategy calls enter short. A matching block, not shown here, handles the long side in reverse. Let's watch this play out on the chart. Notice there is no indicator panel here, because this strategy reads structure directly. Early on, price carves out a swing low, and the green dashed line marks that level, where sell-side liquidity is resting just underneath. A few candles later, price dips below that green line, sweeping the stops that were sitting there, but it cannot hold the breakdown. The candle closes back above the level and finishes higher than it opened. That failed breakdown is the signal, and the strategy opens along the buy entry you see on candle 4. The protective stop sits just below the swept low, while the take profit is projected upward at the fixed reward-to-risk multiple. Price then climbs steadily, and by candle 7 it reaches the take profit, closing the long. Now watch the other side. As price pushes higher, it forms a swing high, marked by the red dashed line, where buy-side liquidity rests just above. On candle 11, price spikes through that red line, taking out those resting stops, but again the move fails. The candle closes back below the level and finishes lower than it opened, showing rejection. The strategy reads this as a failed breakout and opens a short, the sell entry. The stop sits just above the swept high, and the take profit projects downward at the same reward multiple. Price slides lower over the next couple of candles, reaching the take profit by candle 13. So in this illustration, both a long and a short share the same underlying logic. Wait for liquidity beyond a swing to be swept, confirm the breakout failed, and fade it with a structure-based stop. This is a simplified example for educational purposes, and real markets will not always behave so cleanly. That brings us to the end of our look at the Turtle Soup Reversal Expert Advisor. We covered the idea of a liquidity sweep, how the strategy confirms a failed breakout at a swing high or swing low, how it builds its entries, stops, and take profits, and how those rules appear in the MQL5 code. We also walked through a chart showing both a long and a short example. Everything in this video is educational information only, and not financial advice, a recommendation, or a solicitation to trade. Trading involves real risk, and losses do happen. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy studies. You can learn more about our work at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.